Good morning, everyone, and happy Wednesday, and welcome to another insightful webinar proudly brought to you by Standard Bank Global Markets Retail. Today, we have a regular on this platform. Many of you would recall that we had our head of international research, Steve Barrow, earlier this year when we were discussing the tariff storm out of the US. And Steve will share his insights today on the dollar outlook. Before he starts, let me remind you of our house rules. The session is being recorded. None of the information shared by the Standard Bank team on this platform can be deemed as financial advice. Chat to your financial planner for this guidance. And over to you, Steve. Thank you.
Okay, thank you. Yes, I'll just share the presentation. So if you could just let me know that you can see that fine.
Not as yet. Yes,
I'm
it's
getting
perfect.
I'm getting some thumbs up there. There we go. So
Yeah, there
hopefully
we go.
we're okay with that. Right. So the discussion we're going to have today is about the excuse me, the outlook for the dollar and currency diversification. So is the dollar still the best currency or not? And if we look at, I guess really the question is, are we going into a sort of cycle that sees the dollar fall back? If you look at the dollar going back really since we've had floating exchange rates back in the 1970s, you see that for the most part, the dollar sort of seems to go in these long-term cycles, and I've sort of indicated those by the arrows here. This is the dollar against other currencies. So it's not the dollar against the euro or the rand or the yen, but in a sense, an amalgamation of all those different currencies. So we're looking at the dollar as a whole, as it were. And you can see these long-term cycles, generally 5, perhaps 10 years. The most recent upcycle has been broadly since around sort of 2011. And we've seen the dollar rise, and I've put a sort of question mark with a new arrow there to say, have we come to the end of the road on the rise in the dollar, and will we start to go into a down cycle? And from a diversification point of view, if you're an investor, for instance, then is it a good idea to move assets away from the dollar or away from the US and look to go into other markets? So I think there's a few reasons to think that might be a reasonable idea. One is the declining dominance of the dollar, and I'll explain what I mean by that in a moment. Also, the fact that we have seen some investors, some sort of big investors, seemingly reallocating their portfolios away from the US and towards other markets. I think there's an issue as well about what the policy of the US administration is towards the dollar as well. Does the Trump administration really want the dollar to go down? So that's another question. And also just how the dollar has actually traded so far this year. We've seen a broad sort of 10% decline in the dollar against other major currencies so far this year. And I think that it's been trading poorly, which is perhaps unusual in the context of what's been happening beforehand. So 4 main areas that I want to look at there. And with respect to the decline in the dollar dominance, there's some questions about that. What do we mean by dollar dominance? Is that dominance declining, and who will be the beneficiaries? Will currencies like the euro or the renminbi or the yen be the ones the benefit? And does it indeed a declining dominance mean a lower dollar anyway? So what do we mean by dollar dominance? Well, we really mean that it's the foremost international currency. And this chart shows the breakdown in the dollar, euro, yen, and the Chinese renminbi, which is actually so small it doesn't really show up on a lot of these charts, a lot of these bars, as it were. And we look at the level of FX reserves, international debt, international loans, international deposits, and FX turnover. And basically what that's saying, if we start with reserves, is that most central banks hold their reserves in dollars, up towards 60%, as opposed to about 20% in euros and less in yen, less in Chinese renminbi. In international debt, loans and deposits. What happens there is if you're a company in Europe, for instance, and you want to issue some debt, or you want to borrow some, just borrow some money from your bank, you can choose to borrow those or issue debt in euros. But you could also choose to issue debt or borrow money in a different currency. And for the vast majority of people or firms that do that, they borrow in dollars. So the dollar is really dominant there. Again, the euro is second, but quite some distance behind. And as well, in terms of foreign exchange turnover, we know that again the euro really dominates. The dollar really dominates there, and the euro and other currencies are clearly some way behind. So there's no doubting at all that the dollar is the dominant currency globally, and indeed the US policy towards the dollar is in many respects to maintain this dominance. Doesn't necessarily mean to maintain a high level for the dollar, but I think it does mean that the US wants to retain this dominance because in many senses it has a good deal of benefits for the US. But if it loses that dominance, what will happen to the dollar? Now, the only way really perhaps to look at this from a historical perspective is to think, well, which currency used to be the dominant currency before the dollar? And that was the pound. But it's a long time ago. We have to go back to really the shaded region, which shows the sterling rate against the dollar, going right the way back, well, 1800s, shows how since really the dominance of the dollar started to take over back in the 1930s and 1940s, it's been really one-way traffic for sterling dollar. That has fallen. The shaded region there represents economists' estimates of when the pound stopped being the dominant currency and the dollar started being the dominant currency. And there's no one date that you can say that happened. So I've indicated a shaded region there for when that dominance switched from the pound to the dollar. And we can see a little bit of that on the right hand side, or one indication of that in terms of the share of global reserves in sterling and in dollars. Now, again, this goes back to the 1900s here. So it's a very long history, and the history back in the the further you go back, the less history we have, the less indications we have, which is why that sort of chart kind of breaks up. But the key really there is to see how those orange and grey lines really crossed over back in the sort of 40s and 50s, as the share of sterling in reserves went from near 90% all the way down to, well, practically zero by the 1970s, whereas the dollar went in the opposite direction from, close to 10% up to as much as 80%. And as I said, today is about 60%. So we saw that crossover. And we saw obviously the dollar rally quite strongly, since that period against the against the pound. But it seems hard to say in some senses, but hard to believe in some senses that sterling dollar was 5 back in the 1930s and 40s, but that's essentially where it was compared to levels that are closer to 1 today. So there does seem some evidence that if a currency loses dominance, so if the dollar loses dominance going forward, then its value will decline, and that's obviously an important thing to bear in mind. Now, the second factor that I mentioned was portfolio reallocation, and that means basically our investors globally, particularly the big pension funds, insurance companies, the central banks, are they moving or likely to move money away from the US markets and towards other markets? Okay, so one problem I see here, or one difficulty I think that the US faces, is that if you think about it, whilst the US economy has been growing, it's been actually shrinking in terms of its importance in the global economy. I'll show some figures on that a little bit later. So whilst the US has been growing, it's been shrinking in terms of its economic importance. But at the same time, the share of the US stock market in global stocks has really increased quite dramatically. Again, I'll show some figures on that in a second. So what's happened is that a lot of investors around the world have really been pushing money into the US. You know, the tech stocks, for instance, have obviously been important in recent years, but we can go back and see other periods in the last sort of 10, 20, 30 years when funds have really moved to the US. You know, we can think about the dot-com boom and various other times that the US has looked as if it's the place to be, as if not just the US economy is growing stronger than other economies, but its stock market is so much better than other stock markets. But are there signs, and maybe there are signs that that move has come to an end, or more to the point that there's if you like, a concentration risk, that too many investors around the world have got too much invested in the US and they actually really need to reallocate towards other markets. I mentioned obviously this, the way in which the US stock market has outperformed other markets. So if we look at the chart on the left hand side, that shows the US stock market relative to non-US stocks. So when the level is 1, then US, if you like, is on a par with other global stock markets. But when it rises sharply, as it has been doing again since probably around sort of 2010 or so, when it's rising up to kind of nearly 2.5, that shows that the US stock market has been outperforming the other stock markets. The indicators here come from the MSCI index for the US and for non-US stocks. So when that orange line there is moving up, that shows that the US stock market is outperforming other stock markets, and that's really sucked investors in a big way. So when you look at the share of the stock market that the US has right now, different measures there are, but probably somewhere between 50, I would say 50 to 60% of global stock market capitalization is in the US. And you think, if you go back to this chart goes again back to the 1900s, back then it was far less than 20%. And other markets like the UK, for instance, have really shrunk back in terms of their share of global stocks. So there's a real sort of concentration risk here. I think that a lot of investors have put a lot of money into the US, and you could argue that's correct on the basis of how the US stock market has been outperforming. But there is a question as to whether that has really sort of gone too far, and that there could be some correction out of US assets and into European assets or Japanese assets or emerging market assets. And certainly if you look at what's been happening with the stock markets this year, for instance, with all the tariff uncertainty, we've seen, whilst the US stock market has rallied back and the S&P has got back up to record highs again, it's underperformed quite significantly against a lot of other markets, against many emerging markets, against many European stock markets as well, and others, for instance. So there does seem to be some sign here that this period of outperformance in the US either might come to an end, or more to the point that investors have basically just put too much money into the US stock market, and they really need to reallocate more towards other markets to reflect a better sort of share or better portfolio diversification. So that's then the issue with respect to portfolio reallocation. And to go through in turn again what we've talked about so far, we've said that if dollar dominance declines, then we're likely to see a weaker dollar. Portfolio reallocation as well can create a weaker dollar. What about dollar policy, the policy of the US administration towards the dollar? Now, if you listen to the Treasury Secretary in the US, Scott Bessent, and even sometimes President Trump himself, who says they want a strong dollar. But do they really want a strong dollar, or is there actually a bias for weakness? And what do we mean by what do we mean by a strong dollar policy? Well, I think in terms of the strong dollar policy, what the US administration really wants is for the dollar to retain this level of dominance, of influence, because it gives various economic and to some extent as well political leverage that the US has and can exert over other countries. You see that most notably, of course, with respect to countries that the US has big disagreements with, like Russia over the war in Ukraine. So if you're in control, as the US is, of the dollar payment system, for instance, or the Eurozone is in control of the euro payment system, those countries can block the likes of Russia out of that payment system. So that Russia, for instance, is kind of effectively blocked out of the payment system, and that's why in Russia, for instance, there's been a significant move towards using the renminbi or having the Chinese renminbi as a part of its reserves and reducing the dollar reserves. So I think the benefits of having a strong dollar policy are evident, meaning that the dollar is the dominant currency, as we showed in that sort of one of those first slides that we showed. But does that necessarily mean that it should have the dollar should have a high value? And that obviously seems to jar with the with the idea that the US has a very big trade deficit, as we know, and that the tariff policy of the administration is designed to try and improve that trade balance, to try and to turn that big deficit, which is $1 trillion plus per year, into at least balance, if not into a surplus. And it would seem that currency strength doesn't tend to do that, does it? So if you have a currency that is rising, then that can make the trade balance worse because your exports become more expensive and your imports become cheaper. It sort of works against the tariffs. So I would question whether the US really, in a sense, it wants dollar dominance, but does it want the dollar to keep rising? Well, I don't necessarily think that it does. And indeed, if you look at the administration's policy with respect to many countries around the world, particularly in emerging markets, particularly the likes of South Korea, for instance, and even Japan, policymakers in the US are concerned that these countries maintain undervalued currencies, and they really should be making efforts to make those currencies stronger. And if you make if the US is putting pressure on South Korea, for instance, to make the South Korean won stronger, then by definition, it's putting pressure on to weaken the dollar against the South Korean won. So you can see from this that there's a little bit of a conflict, perhaps in some senses, between having a dominant dollar policy and having a strong dollar policy, or having a policy of wanting the dollar to get stronger over time. And I mentioned earlier about the decline in the share of the US's economic importance, and what we've got here is we look at the share of global GDP that goes to the US, which is around 14% or so at the moment, 15%, and the share that goes, for instance, to emerging markets, and also with projections over the next few years where those trends are broadly expected to increase. In fact, if we project out or use projections that go right the way out to 2050, which is on the right hand side, you can see how the US share is projected to go down to 12%. China's share is projected to go up to 20%. India's share is projected to go up much more significantly, not far off double to 15% by 2050. So what is happening is that the US is shrinking in terms of the global economy. But the problem, and this is where sort of the more kind of academic debate within the White House goes, is that the problem with having the US shrink relative to the rest of the world is that the rest of the world still wants dollars, still wants large amounts of dollars, because the dollar is dominant, and that creates a difficult position for the US, and a large part of that is reflected in its trade deficit. I mentioned earlier that this trade deficit has obviously become very large. So the chart on the left-hand side there shows the current account deficit, which is the grey line in terms of billions of dollars. So it's well over $1 trillion at the moment, 3 times what it was back when Trump was sort of first in office. And as the orange line shows the current account as a proportion of GDP. And then if you look at the chart on the right hand side shows basically how much external debt the US has, which is in a sense if you were to add up all those current account deficits going back over time, then you would arrive at a deficit, a net international investment position deficit that is the brown line on the right, on the left-hand axis shows that that level of external debt at the moment is about $26 trillion, or about 90% of GDP. What this kind of tells us is that what is happening in the world is that the US has a huge, big trade deficit, and pretty much other countries have, or the big countries anyway, like the Eurozone and China and Japan, and they all have big surpluses. And so that's a problem for the US administration. That's one reason why we have the tariff policy. And I think it's another reason as well why, when it comes to the US administration, that their policy towards the dollar, whilst they want it to be dominant, that doesn't necessarily mean that they want it to keep going up. Because if it keeps going up, it's probably going to make these trade deficits get bigger. And that's the opposite of what the administration wants. And I think another point as well about the dollar, and this chart actually is a repeat of the chart that I showed at the start, which was showing the ups and downs of the dollar going right back to the 1970s. In this case, it starts off in 1980. But what I've overlaid on this is the administrations that we've been through over the last sort of 50 years or so. The orange, the pink colors are supposed to show the Republican-led government, so Reagan and Bush, and then Bush Jr., and then Trump's first term, and the orange, pink, sorry, at the end there is Trump's second term. And between those lie the Democrats, Clinton, Obama, and most recently Biden. They're colored in blue. What you sort of, one thing you sort of notice here is that the dollar tends to rise when the Democrats are in power, Clinton, Obama, and Biden. But when the Republicans are in power, it tends to be probably often a bit more volatile, but more often actually go down. So the Reagan and Bush era, for instance, the dollar ended, notably lower than when Reagan first came in at the end of Bush's term. With Bush Jr., we saw again the dollar end his term, or his 2 terms, much lower than where it started. As far as Trump is concerned, during Trump's first term, we didn't really see the dollar slide in the same way. It certainly ended lower than where it started. And didn't experience the sort of rally. The Trump's first term was interesting in the sense that we had a significant rally in the dollar through most of Obama's term, and a significant rally through most of Biden's term, and yet squeezed in between those two was Trump, where the dollar actually fell slightly. So there seems, if anything, from this to be some sort of reason why the dollar tends to do better under Democrat presidencies than Republicans. It might be coincidence. There may be no relationship at all. We can't really tell. My sense is that there probably is a relationship, and it's probably down to the way in which the budget and budget policy particularly is run. Because what would happen if I was to overlay the budget, government budget on here, the budget deficit in the US, you would find that generally under the Republican presidents, it gets worse. And under the Democrat presidents, the budgets get better. And that's partly because some of the Republican presidents in the past have had significant and costly crises to deal with. So Trump had to deal with COVID. Bush Jr. had to deal with a global financial crisis towards the end of his term. So they had big fiscal costs. But I think even leaving that aside, what you find is that the Republicans have tended to see the budget deficit situation get worse. And if we bring it forward to to now and to what's happening with Trump in his second term, we've obviously just had passed fairly recently this one big beautiful bill, as he labelled it, which is estimated to increase the budget deficit really quite substantially, $3.4 trillion over the next 10 years. That's the estimate from the Congressional Budget Office, and various other estimates are around the same sort of level. So what is happening in the US with budget policy is concerning, not just because we're seeing this big increase in the budget deficit, but also because we're seeing it at a time when the government debt level in the US is already very high indeed. And you can see how that's impacting policy, and perhaps impacting policy negatively, and the dollar may be negatively as well, because the president is putting pressure on the Federal Reserve to cut interest rates. Now, very often, if presidents put pressure on central banks, to cut interest rates, it's usually because they don't like the high interest rates because they're holding back the economy. So if you think about Turkey, for instance, President Erdogan has been very vocal in the past in wanting interest rates to come down, but generally that's because the rates have been very high, 30-40%, and that's held back the economy. In the US case at the moment, President Trump wants lower interest rates, not because the economy is weak, but because he wants to reduce the costs of funding that budget deficit. He wants lower interest rates to improve the budget deficit, as it were, and that creates perhaps a troubling sort of political influence over the Federal Reserve. Economists have a word for that, which is basically it's called fiscal dominance, and that means that central banks, who normally would increase or reduce interest rates just on the basis of what's happening with inflation, may also have to think about what their decisions imply in terms of the cost of funding the government budget. And that's certainly an issue that's been of concern in Japan, for instance. There, the government's debt to GDP ratio is about 250%, as opposed to 100% or so in the US. So when the budget deficit becomes very big, monetary policy can perhaps no longer be just dependent on how inflation is moving or how the economy is moving, but the costs that are implied for fiscal policy, and that's a worrying development. So if history kind of repeats itself with respect to the dollar, looking at the political cycle, then most likely we won't see the dollar go up under the Trump administration. If anything, it's perhaps more likely to go down. I think another point I'd make as well about the way in which the dollar has been trading, certainly so far this year, is that it's been trading poorly relative to how we might expect it to trade, given some of the things that have been going on. We've had the tariffs, we've had changes in interest rates, and we've had heightened risk aversion as well. The global economy has been a very uncertain place. We've had bouts of very significant weakness in riskier assets like stocks, as we saw back in April. And yet the dollar has traded quite poorly through all of those. If we look at tariffs, we can see how the US under Trump has now pushed tariffs up probably somewhere around levels that haven't been seen since the 1930s. And if there is any sort of theory or historical evidence for what tariffs should do to a currency, then they should and have in the past tended to make that currency stronger. A very simple argument here is that if the US imposes these tariffs on other countries, particularly if they're significant tariffs, then the US will import less from those countries. If you put a 30% tariff on China, then you're probably going to import less Chinese goods. and that's going to improve the trade balance. And if if the improvement in the trade balance is thought to lift the value of the currency, then that implies that tariffs should lift the dollar. And if we look at how the dollar has traded in the past, when not just the US but particularly other countries have imposed tariffs, we've generally found that those currencies have gotten stronger with the tariffs, not weaker. But this year, we've obviously seen the dollar go down, even though those tariffs have been introduced. So that's quite a negative development, if you like, as far as the dollar is concerned. In terms of interest rates as well, normally, at least within the advanced countries, and even in a lot of emerging market countries, you'll tend to find that investors often gravitate to the currencies that have the high interest rates, particularly if there's no sort of associated inflation problem. And if you look at the US, what the Federal Reserve has done this year is it's basically held interest rates stable, and most other central banks, Bank of Japan excluded here because it's raising rates, but most other central banks like the ECB, the Bank of England, Swiss National Bank, for instance, those central banks have cut interest rates. So the US federal funds rate, the key policy rate, is quite a bit above the average rate amongst the other G10 currencies, about 2% above. So this chart on the left-hand side shows the difference between the federal funds rate on the one side, the US policy rate, and the average of the policy rate amongst other central banks. So the US has quite a considerable interest rate advantage at the moment, at least in terms of policy rates. And the chart on the right-hand side sort of shows that a little bit with respect to bond yields as well, where we saw back in in April of this year quite a notable improvement in improvement in eurozone interest rates relative improvement in US rates relative to the eurozone, and yet the dollar has been weaker over that time. So I think that's concerning, because normally you'd expect that, when interest rates go up relative to others, I know they've not actually been increased by the Federal Reserve, but even just holding those rates steady at 4.5% at the moment, whilst others have been cutting, has increased the US's interest rate advantage. But despite that, the dollar's been going down. It's not been going up. And just to be clear, on the chart on the right-hand side there, we're showing the euro dollar on the left-hand side, and the bond yield differential on the right-hand side. So the dollar's not been trading well in terms of tariffs. It's not been trading well in terms of interest rate differentials, and it's not been trading well when it comes to risk as well. And what do we mean by risk or uncertainty? What we mean here is are we in a period where there seems to be a great deal of uncertainty and a great deal of risk? And I would argue, and I think most people would probably agree, that if you think, over the course of this year so far, we've seen quite significant increases in uncertainty, particularly around tariffs, but also around other aspects of US policy. Significant uncertainty and significant bouts of risk as well in the markets, and that was perhaps shown most clearly by the way in which the stock markets have fallen very heavily through to sort of May, and have only just sort of recovered in the last month or two. So that left-hand side chart shows a measure of policy uncertainty surrounding the US. How do we measure that uncertainty? Well, the most simple way of measuring policy uncertainty is to scan through newspapers and media and to look for times when the word uncertainty is mentioned in an economic context and mentioned in the context of financial markets. So again, with AI, we can just use AI to sort of data mine basically all the media to see when, how often that word of uncertainty is used in an economic context. So that's how we measure it basically, and that's the grey line on the left-hand axis, and you can see there how that has really leapt this year relative to what we've seen in the last couple of years. What we would normally expect is that when there's a period of high uncertainty, people rush to the dollar. They want to hold the dollar because it's the safe asset, and therefore that's the one that everyone should really be holding. But what we've actually seen this year is that the dollar has fallen, even though that risk level has increased, or uncertainty level has increased quite significantly. So the orange line on that left-hand chart shows us that the level of the dollar has actually fallen back quite sharply this year, even though the level of uncertainty has increased. So what does that sort of tell us? Well, maybe it's telling us that the dollar is not as safe as it used to be. And the chart on the right-hand side, same sort of thing, really. It's just looking at the quarterly changes in the level of policy uncertainty, US policy uncertainty on the horizontal axis, and on the vertical axis we have the quarterly percentage change in the dollar index, and that orange line slopes upwards. And that's basically saying that, for the most part, what mostly happens is that when policy uncertainty increases, the dollar gets stronger. It's really just, a repeat of what we were saying on the chart on the left hand side. But I've marked here, for instance, how we've seen a big increase in policy uncertainty. So the current sort of diamond shape, if you like, is quite a way along the right hand, quite a lot way along the horizontal axis. That's not, crowded around the zero line as most of them are. So that shows that uncertainty has increased really quite substantially. But the horizontal axis shows how the dollar has declined despite that rise in uncertainty. And if we take another example, what happened in the financial crisis, Q3 2008, we saw an even bigger level of uncertainty at that time, but we also saw a much more positive reaction in the dollar. The dollar rallied by around sort of 10% or so in that quarter, as opposed to the sort of 4 to 5% decline that we've seen in the first quarter of this year. So again, that's a reflection of the dollar, in my view, sort of trading poorly. Its uncertainty has increased quite substantially, mainly driven by tariffs and uncertainty around tariffs, and yet the dollar has weakened and not strengthened. So to sort of try and answer the question that we posed at the start, and that is whether the dollar is likely to enter a longer term down cycle. Well, I think broadly speaking, it is. So when we look at the forecasts for euro dollar, for instance, we're sitting around 116 at the moment, then the forecast over the next year or two is for a move up to 130, 135, dollar yen down to 125, 120, and similar moves in the other G10 currencies. And before I finish off, I'm just going to add in one final thought, and that is that when what we've been discussing so far is basically, is the dollar better than the euro? Is it better than the yen? Is the yen better than, what currency is the strongest, is the best one? And if we were to think about, a portfolio of assets, for instance, then should we be focused on US assets and the dollar, or should we look to Europe, or should we look to somewhere else on the basis of currencies? But there is another aspect here, which is to think about how currencies move as a group, or in a sense, are all. I guess where I'm getting to is actually all currencies are bad. And what I mean by that is that if you were to look at currencies, in this case we've used the yen, but it doesn't really matter which currency we use in this chart. But if we think about measuring a currency not against another currency, so not the yen against the dollar, or the dollar against the rand, or the dollar against the euro, but the yen against another asset that is not a currency, but in theory at least is meant to hold its value. So here we've got gold, where we've gone right back to the 1970s. and the yen against crypto, or Bitcoin in this case, which obviously has a much shorter history. The reason for using gold is partly down to the fact that, again, at the start I showed some of those longer term charts of sterling dollar, if you remember, being up at 4 and 5, and those sorts of things. And those were periods when gold was the sort of, economists call it the numeraire of the currency system, so global currency system. So currencies were, for instance, up until the 70s, the value of the dollar was tied to gold. And why was gold used? Well, gold was used primarily because it's in relatively restricted supply. So there's obviously some, an amount of gold that has been mined. There's an amount of gold that will be mined in the future, but that supply is likely to, or historically anyway, has tended to only increase fairly slowly. So if you increase the supply of something else very fast, like money, like dollars, like yen, or like other currencies, then the value of gold, then gold is likely to go up in value relative to those currencies. Now, if we look at what the history has been in terms of the yen against gold, for instance, then you see, ups and downs. It's not, it's improved, but it's not been substantial up until probably the last decade or so, where it's really moved up, very, very aggressively. And if we had the dollar against gold, we'd show a similar sort of thing, and the euro against gold, another. So basically, what this is saying is that all these currencies have lost a lot of value against gold. And why have they done that? Well, that may be because whereas gold is in quite restricted supply, a lot of the central banks have been really increasing the supply of their currencies very substantially. We remember after the global financial crisis, we saw a lot of major central banks take interest rates down to zero, even below zero in some cases. We saw this quantitative easing where central banks would be buying bonds and sort of supplying cash into the market, and that maybe undermine their currencies as well. We talked, I mentioned as well, this idea of fiscal dominance, that a central bank such as the Bank of Japan, for instance, might want to raise interest rates to sort of slow down the supply of its money. But it maybe feels that it can't really do that, because if it increases interest rates, then the cost of servicing the government's debt increases, and that causes a problem. We mentioned that term fiscal dominance before. So those are issues that tend to suggest that certainly in the last decade or so, there's been this real evaluation, if you like, of money relative to other assets or forms of not money, but other assets that are meant to have value. And it's a similar sort of thing with Bitcoin, because whilst there might be many different arguments for why cryptocurrencies are attractive, such as avoiding scrutiny, for instance. In essence, the attraction of Bitcoin and others is because their supply is restricted. And if their supply is restricted relative to the yen, where the supply of yen is not restricted, then the value of that cryptocurrency could well appreciate. And we've obviously seen that as that chart shows, the right hand side, the orange line shows the cryptocurrency Bitcoin relative to the yen, as Bitcoin has rallied obviously very dramatically. And again, that's the same case against other currencies as well. So although this this argument in a sense might be a little bit sort of complicated or convoluted, what it's basically saying is that if the basic argument is, we started with at the beginning of this talk, was which currency is best, the actual answer may be no currency is best, that the best thing is actually something that's not a currency, that is restricted in supply, that therefore holds its value better, when a lot of central banks around the world have behaved irresponsibly, perhaps in some ways, and really allowed their currencies to, in a sense, devalue, or through pursuing monetary policies that have been really very aggressive and have taken interest rates down to very low levels or and increased the supply of money. It was interesting. I think it was yesterday or the day before that you may have seen Ray Dalio, the head of Bridgewater, said that investors should have 15% in either gold or Bitcoin, or perhaps a combination of both. And I think that's not a bad starting point, to be quite honest. And his arguments for that are pretty much the ones I've given here, which is that really in many senses you could probably argue that all central banks have probably acted in a way that is not prudent, and governments as well, perhaps in a way that's not prudent given high levels of debt. And as a result of that, all currencies are looking or have been and may continue to be vulnerable as a consequence of those actions. So the basic conclusions, so what I've said today are, yes, the dollar may be a currency that has been the strongest, but may start to, or is expected to lose that strength. But there's also a case for holding assets other than currencies in a portfolio. I'm going to stop there.
Thank you very much, Stephen. I just have a few questions on the chat. What is the view of the USD ZAR for the next year? If you've got...
Yeah, I mean, I think that the interesting thing about I don't forecast the dollars are myself, but I can tell you what our analysts are looking for there, and where, and some of the justifications for that more from the US side, or from the dollar side of the dollar rand equation. One thing I mentioned during the presentation was that if you think about how the dollar has traded this year, it's actually traded in a way that has been quite poor, and in many senses quite poor relative to emerging market currencies as well. And in general, emerging market assets have performed quite well in an environment where we might have expected them to have traded much more poorly, given the very high levels of uncertainty. Countries, South Africa hasn't, I don't know, maybe it has, but I can't remember it facing a 30% tariff from the US before, for instance, or other countries around the world, facing Vietnam facing a 46% tariff from the US. So these things are, really quite significant. And yet, if you look at how the currency markets have traded, they've actually traded relatively. I think that these currencies and assets in general have actually traded relatively well, and that sort of speaks to the idea that maybe the dollar isn't as dominant, as important, as strong as it has been in the past. And so when we look at our forecast, then for instance for the dollar rand, we're sort of looking at averages of just slightly above the 18 level going forward over the next few years. So we're not anticipating that the dollar is at least going to average levels. They're up at 19, 20, 21, and this sort of thing. And so obviously I can only really speak from the dollar side of that equation, but that kind of view on the rand sort of fits in a sense with what we're saying against the dollar. So whereas I would say that the dollar may lose value against some of the major currencies like the euro or the yen, it's more likely in our view to sort of kind of be more stable, if you like, against the rand, which would be a good performance for the rand in some senses relative to the history we've seen.
Thanks for that. And I've got another question around crypto. What impact will that have?
Well, I think there's many different aspects to that. I mean, and I'll talk in very basic sense for those that maybe not so familiar with crypto. There's in a sense there's two things going on here. One is the issuance of cryptocurrencies such as Bitcoin, as we mentioned, and that value of Bitcoin can move around wherever it wants, because it's in a a tradable market, and obviously is very volatile, and that's maybe one of the reasons it's or detracts from its attractiveness, if you like, because it is very volatile. But nonetheless, it can move around, and that is perhaps not where the interest lies. However, there's more interest, I think, from the US's perspective about so-called stable coins, which are again issued privately, but they are linked to the value of the dollar on a parity basis. Yeah. So basically, if a company or a bank starts to issue stable coins, then they will have to buy as many US assets, which are normally bonds or short-term treasury bills in the US, to cover that asset. It's 100% backed by a hard dollar asset. Yeah, so it makes it different from something like Bitcoin, which is not. But the point really, in terms of currencies going forward, is, I've obviously mentioned the arguments as to why crypto may be of a good asset to hold in some senses because of the supply issues around currencies. But I think there's another issue as well, which is that if stable coins really take off, then you can see from the US administration, and particularly the legislation that the Congress has just pushed through, that the US wants to dominate in that stable coin issuance, and what it wants to do is it wants to use that as a way to continue, if you like, the dominance of the dollar. Yeah, because if most people around the world use a dollar-based stable coin, then in a sense that's providing a demand for dollar assets like treasury bills or treasury bonds that back it up, as opposed to if if a euro stable coin or stable coins were used primarily, or a renminbi stable coins, for instance, because that would then create a demand for eurozone bonds or for Chinese bonds. So you can see the way that the US is trying to move on this to sort of capture that space, and there is obviously some suggestions around that President Trump is doing that more for personal gain than for cementing the dollar's position. But that is an interesting and perhaps potentially a counter argument to some of the arguments I was giving earlier, that the dollar may lose its sort of globally dominant, not lose its position, but may see its globally dominant position erode a little bit over time. Stable coins could actually be a counterweight to that.
Fantastic. And there's another question. If you had to pick any foreign currency to hold today, which one would it be?
Swiss franc. If you look at I showed a chart earlier of how the dollar has moved against other currencies, and a particularly good way of measuring how currencies perform is to look at it against inflation as well, not just inflation in the US, but inflation in other countries, and to try and get a sense of in real terms, because we all know that real terms is what's is important. Yeah, there's no use in investing in an asset that goes up 10% if your inflation rate goes up 20%. Yeah, so we know that real terms are what's key. If you think about the dollar, the dollar's effective exchange rate, or its trade weighted exchange rate, or its general sort of level, if you like, in real terms, has gone up and down over time. Yeah, I said since 2011 it's been going up. It may go down in the future, and in the past, if we look back, we've seen these long periods where the dollar has gained value and lost value. It's gone up and down, up and down, up and down. If you look at the Swiss franc, it's gone up and up and up and up and up. It's never really gone down in real effective terms. The interest rate on Swiss deposits is practically zero, so you do pay for that. But it has gone up continually, and it probably will continue to go up continually. So the Swiss franc would be my choice.
Fantastic. There's a similar question on the chat. about which reserve currencies seem to be most appealing given the current economic landscape, the geopolitics.
Mm.
If diversification away from the dollar is needed, what's your take on gold and ESGs?
Yeah, if you look at what central banks have been doing, so if we're talking about currency reserves of central banks, and often it's worth, sort of following what the central banks do. They should have a reasonable idea about, the right assets to hold, particularly from a safety aspect. You think about why central banks hold reserves. Main reason is, those reserves are the population's money. Yeah, they don't belong to the central bank. They belong to South African citizens or US citizens or any other country's citizens. So their primary focus there really should be on maintaining the value of those. So there is a secondary issue, which is that if they want to intervene in currency markets, then they need a liquid currency that they can use readily to intervene. And that's why the dollar is a significant portion of those global reserves. But I think if you look at what diversification has been going on amongst the central banks, you do see a very significant diversification into gold. I think we've been through a number of reasons as for why that might be the case, and diversification as well has actually been a little bit more sort of broader based. It's not that global central banks have moved from dollars to within the currency space. They've not moved from dollars to euros or to renminbi or to the yen. They've tended to sort of move across currencies, and there's even a lot of the more minor currencies that have seen their share increase, like the Canadian dollar, for instance. So it's been a broader move, but the most notable and most significant one has probably been towards gold.
Thank you for that. There's another question on the chat, and is the US service industry, including global services provided by companies such as Microsoft, included in the trade deficit calculation? And if not, why not?
No, those things are calculated. I think where the US has a concern, it doesn't necessarily reflect it. Well, it can reflect in the balance of payments data. Is where the US has a concern is where you have US companies that have operations abroad, or maybe don't even have operations, but just have like a nameplate, if you like, in a different country to be able to pay their taxes to that country. So a really good example is Ireland and US, not Microsoft, for instance, but but the pharmaceutical companies in the US, where a lot of those produce in Ireland and pay their taxes in Ireland. So the tariff policy from the US is primarily designed to try to bring those um, companies back to the US, because very often, the likes of pharmaceutical companies might have operations in say Ireland, and when they make profits in those countries, they'll keep those profits there, and the US wants those to go back. And if that goes back, then that, in a sense, will improve the balance of payments for the US. But in terms of just general things like exports and imports, no, someone like Microsoft and all the other US companies will be included in the data.
Cool. And what most people ask is why tariff policy can help the US, since tariffs are essentially a tax on consumers through import duties. Trade is the result of excess and shortfall balancing across countries, not something that can effectively be controlled through tariffs. So, why such a push on tariffs impacts the exchange rate, specifically the dollar?
It's a good question, and I probably don't know the answer. Because as an economist, yeah, I don't really see. I agree with all the sentiments there that there's nothing wrong with having a trade deficit. I mean, that's the key point, really. Actually, trade deficits and surpluses are good in in the sense that they allow countries that perhaps are less competitive in some areas to import the goods they need, and vice versa. So there's nothing inherently wrong with trade deficits. I think the issue the administration has in the US is that the deficit in the US is very large. So it's over $1 trillion a year, as President Trump keeps mentioning, and they don't like it being that size. They do think that uh, uh, as I mentioned, going back earlier in the presentation, they do think that there is a problem associated with running up those deficits year after year. They mentioned $26 trillion worth of external debt. Of course, everyone focuses in the US and elsewhere on the budget deficit and how that's large, and the levels of debt in the US on a domestic front. But a lot of that debt is sold to foreign investors, and so the foreign deficits are very large, and that's what the US wants to improve. Can tariffs improve trade? I don't think they can. Wasn't a great deal of evidence from the original Trump administration. That being said, what's happened under this administration is that the tariffs are across everyone. Everyone's going to, everyone is suffering, and everyone is going to suffer. There's not going to be any countries that get a zero tariff, or any significant countries that get a zero tariff. And the reason for that is because the Trump administration doesn't obviously want what happened in a sense in his first term, which was that you put the big tariffs on China, and then Chinese kind of production in a sense moves to Vietnam or to another Asian country, and then those exports go into the US. So the US trade balance with China improves, but it deteriorates with Vietnam and Japan and various other countries. So there's no overall benefit. They're trying to block that off this time. I still think it won't work. As I said, again during the presentation, tariffs in theory should make currencies get stronger. There is a sort of theory behind that, and history does tend to show that. I think the fact that it's not happened so far, and particularly if it doesn't happen going forward, really in a sense, once these tariffs, the bigger tariffs really sort of kick in, I think that's potentially quite a negative sign for the dollar.
Thanks, Stephen. I'll allow for one more question. We are at the end of our session. Fanny, your hand is up. Can you just ask a question? I've unmuted you. Fanny, are you there? Okay, doesn't look like Fanny is there. Thank you very much, Stephen, for your insightful chat on this. We'll look forward to many more. I'm sure this is not the end of many conversations around this. And thank you everyone for making time this morning to join us. And we will see you at the next one. Thank you very much. Bye.
Thank you. Bye-bye.